Buying a house is not always a personal choice, assuming you have the financial capability to make that decision. It's always a big step considering that owning a home is deeply ingrained in the American dream. For ordinary buyers, owning a shelter in a neighborhood and having a place to call home is their sole motivation. On the other hand, some buyers are financially motivated, hoping to buy a house today and flip it for a higher price later. These individuals are less interested in social stability and only inclined to make profits. These two types of buyers make up a significant part of the housing industry. They are the ones that make the market tick. If housing prices go high or low, they are the ones that feel the impacts. With this in mind, they are expected to check the market trends and movement before making a purchasing or investing decision. Their purchase decision can be backed by looking at the macro and microeconomics of the economy and industry itself. This helps them understand the best months, periods, or years to buy a house. Now, one of the questions from these buyers might be about the possibility of 2021 being a good or a bad year to buy a house. In this video, we assess the fundamental and technical reasons this year might not be the best year to make that purchase decision. We're also going to propose alternative solutions on how you should approach the housing market in 2021. So here are 3 reasons not to buy a house in 2021, or at least reasons to consider. Number 1 is alarming evidence of a housing market bubble. They say the worst time to buy an asset is in the midst of a bubble. Although some experts may hold some reservations on the matter, 2021 could be the year the housing market bubble bursts. The pop seems inevitable considering how the house prices have skyrocketed in the past few years. Before dissecting the possibility of a housing bubble in 2021, we must first understand what it entails. What is a housing bubble? A housing bubble is usually an accumulation of artificial price drivers. These inorganic drivers push the demand for housing assets up while the supply remains constant. Among the contributors to a bubble might include the mix of the following: an artificial rise in the economic activities that raise the demand for physical assets. As Investopedia.com puts it, a housing bubble can be a result of a rise in general economic activity that puts more income in consumer pockets, thus encouraging home ownership. A rise in the number of consumers within a geographical location. This can be as a result of population increase, thus raising the need and demand for shelter. The possibility of a lenient lending industry. Mortgage lenders may avail low short-term interest rates that makes home ownerships much cheaper. Lowering credit qualifications may also attract more borrowers, pushing the demand and house prices even higher. The possibility of high-risk mortgage lenders in the market coming up with cheap monthly lending programs that make home owning significantly cheaper. Potential market mispricing by mortgage players, making loan products readily available even for bad borrowers. Potential market conditions and regulations that promote house speculation. These speculative behaviors involve large volumes of property buys with intention to sell higher. Such conditions reduce housing supply, thus pushing the prices even higher. So, what's the evidence of a housing bubble in 2021? A significant part of this evidence points to 2020, a year of pandemic and uncertainty. During this period, there was an increase in the number of artificial drivers that pushed the housing prices even higher. Even more worrying, the push happened when other industries were going down, thus raising suspicion of a bubble. Among the reasons 2021 could be the year of a housing bubble include the following. During the start of the pandemic, there was a significant rise in the number of sales. In fact, in the United States, the housing index was at an all-time high in September 2020. It was at $226,000 when the general economy was on a downhill. The low interest rates and incentives from the bank and governments contributed to the industry bullish movement. The United States and the United Kingdom governments came up with encouraging incentives that welcomed house buyers during the pandemic. For instance, the United Kingdom £15,000 stamp duty waive led to a massive rise in property demand. The furlough that ends in March 2021 will see the market correct to lower levels. Potential rise in speculative behaviors in the past few months. With lenient government and bank terms, it may have attracted speculators to take position in the market. These speculators might dump prices down and take their profits as the year goes on. The potential of bad borrowers from bank leniency during COVID-19 might have dire consequences as 2021 proceeds. So what happens if you bought a house during the midst of a bubble? Buying a property in the midst of a bubble might lead to devastating financial impact. If you bought now and the bubble popped a few months later, your property valuation will be much lower. With speculators dumping their positions and other owners selling, it would bring the housing industry valuation significantly lower. This would also apply your asset valuation, which would be valued much lower by then. Number 2 is foreclosures and evictions are the horizon. The pandemic effects aren't limited to its contribution in creating a bubble in the housing market. Its impact is expected to continue in all economy sectors, including the property industry. Among the expected results in the growth in number of foreclosures in the coming months. With a large part of people financially hit by the pandemic, it could have devastating effects on their ability to repay their mortgages. Foreclosures affect the industry in a different way. It starts by increasing the asset supply in the market. When a borrower can't fulfill their mortgage obligations, the lender forecloses. This increases the housing supply, thus reducing the property prices. If this happens en masse like it did after the Great Depression, then the market may crash to new lows. Investors and speculators expecting these massive dips might also liquidate their positions en masse. The ripple effects of lenders and investors selling their positions simultaneously can be damaging to the industry and the country economy. While we might see a wave of foreclosures and evictions in 2021, most governments reacted to the pandemic by coming up with measures to help mortgage borrowers during the pandemic. Among them included coming up with moratorium on evictions and foreclosures to help those affected by the pandemic. However, this protection will have run out by the end of the first quarter of 2021. This will leave a lot of borrowers exposed and vulnerable to foreclosures. Evictions might also go higher during this period. With unemployment hitting new levels, one would expect a rise in the number of defaults. According to dsnews.com, unemployment rates were about 15% during the first wave of the pandemic and has settled to about 6.8%. This is almost double to the rates prior to the pandemic, which was averaging about 3.5%. The rise in unemployment will leave borrowers in a precarious situation. They will be either left to refinance their mortgage or sell before the foreclosure. If they are unable to do both, they will lose their house to the lenders. Considering the high levels of unemployment, the latter case is more probable, leaving the lenders with no option but to bring the asset back to the market. The property market will also be affected by the unemployment caused by the pandemic. Defaults and evictions are expected to be on the rise in 2021. With a significant part of the tenants unable to pay their rent, rental property owners may be left to fulfill their agreements with the lenders. Considering that major job losses has been concentrated in the low-wage workers, the rental property market will keep feeling the COVID-19 effects. This group of workers are less likely to buy a home and thus opt for rental homes, and their unemployment may lead to evictions and defaults by the property owner. Why you shouldn't buy a house with impending foreclosures in 2021. The evidence we just discussed shows the possibility of impending foreclosures are likely in the latter months of 2021. As you would expect, foreclosures will add more supply to an already overpriced housing market. As mortgage lenders add more supply to the market, one can only expect a dip in the price. House flippers and speculators are also likely to see an impending wave of foreclosures and may sell their position. Assuming you bought a house before all of that, then its valuation will go immensely down from this addition in supply. This explains why it would be advisable to wait for these wave of foreclosures to happen before buying a property asset. Number 3 is going to be renting will be much cheaper than buying. There has always been a debate between renting versus buying a house. Although both have their own pros and cons, renting is much better, especially in 2021. This argument applies to investors and also homeowners who might be interested in buying a house. For investors, they need to understand that the demand for rental space will keep going up and may surpass the demand for home ownership. This can be attributed to the economic reasoning that renting a home is cheaper than owning and maintaining a property. It's easily arguable that the upfront cost of renting is extremely lower than buying a house. This financial flexibility prompts people from making the huge initial investment of purchasing a property. This is expected to be even more applicable after the pandemic, which left consumers with less disposable income. Considering the economic constraints expected in 2021, more and more people are less inclined to make huge investments. Renting just requires a deposit equal to 1 month rent, whilst owning a home may require about a 20% down payment of the total asset valuation. This upfront cost may discourage buyers, especially in the pandemic year recovery of 2021. The maintenance cost of owning a house is also considerably high. On the other hand, renting a home is great as one doesn't have to pay the maintenance and repair bills. It's usually left to the landlord to fix, replace, improve, and repair. After the economic struggles of 2020, few people will be willing to cover all of these costs from their own pocket. Furthermore, the real estate taxes also make owning a house a little more expensive. These taxes are calculated by estimating the property value and amount of land occupied. They are also expected to go up in 2021 as the government attempts to raise more funds in a bid to help the economy recover. Other than tax costs, investors and buyers are also comparing the insurance expenses between renter and the homeowner insurance policies. The average expense of a rental insurance policy is around $180, while homeowner policy averages $1,200 per year. Now, those costs and expenses will influence potential homeowners and investors. For prospect homeowners, they might analyze and opt for renting due to fewer and lesser costs. On the other hand, investors might predict the pandemic effects extending to 2021, forcing consumers to opt for rental services instead of homes. The bottom line: buying a house for an occupation or as an investment shouldn't be a casual decision. It should be a well-thought decision motivated by solid indicators to ensure your investment is properly protected. This includes assessing the possibility of a housing bubble and foreclosures and how it might affect the asset in the future. Today, those indicators show that 2021 is not the best year to buy a house. It is a year after the skyrocketing property prices in 2020, thus possibility of an overpriced market. It is also a year that could see the effects of the pandemic escalate, leading to defaults and foreclosures that could significantly lower the market valuation.